on speaker.
Hi, John. Okay, we're live on here. We're ready to go, Madam Chair.
I call the Employees Retirement System of Tulsa County's meeting to order.
And we're gonna call roll, so we can just let everyone know who is on remote and who is live. Michael Willis.
Here.
Heather Little. Here. Tony Kaiser.
Here.
Dennis Simler.
Here.
Sunny Lynn.
Here.
And John. Here. I think that's all.
Ron Peters is here too.
Melissa.
Melissa.
Yes, I'm here. This is Melissa.
Ron Peters is on as well.
Okay, thank you, Commissioner Peters.
Okay. First is minutes from February 25th, 2020.
Move approval.
Second.
Baker. Hurt. Hurt. Sunny.
Yes.
Ford.
Yes.
Peters.
Yes.
Simler.
Yes.
Willis.
Yes.
Kaiser.
Yes.
Little.
Yes. Do we have any unfinished business?
Not that I'm aware of.
Okay. Next is accept and file the treasurer's report from February 29th, 2020.
There's acceptance file.
I thought Father Gill was going to present it. Is he not presenting?
He's here today. I don't know where he is at this moment.
Okay, so do we just?
You know what? Let me call him.
Okay,
Or let me text him. And let's just, if Madam Chairman, if you wouldn't mind passing. this.
Okay, we'll pass that, come back to it. Next one is accept and file investment manager reports for Siegel, Bryan, and Hamill portfolio review.
Move to accept and file.
Second.
Baker. Hurt.
Yes.
Ford.
Yes.
Peters.
Yes.
Miller,
Yes.
Willis.
Yes.
Kaiser.
Yes.
Little.
Yes. Next, discussion of possible action investment consultants. Doug.
Morning, everybody. Quickly go through a few issues related to the February 29th report, which should have been distributed earlier today. I think we all know it's been a difficult market. We've had substantial volatility in both directions, which is typical of when we're going through extraordinarily volatile times like we have right now. That being said, it really appears that the unprecedented lengths that federal government, both through the executive and through the Treasury and the Federal Reserve, have put into the market is remarkable. As stabilizing a credit market, which was non-functioning about a week and a half ago, to where we are today, it's been a marked improvement. Will it be straight up from here? Decidedly no. I think that the issues that we're having with the virus, I think the issues that we're having with responses to that, both from a health, which is primary, and then economically, this will be an environment that I don't think any of us have seen for some time. So briefly, just going back to February 28th or 29th, which was the end of the previous month, and we'll be getting out materials as soon as we can after we close the business. But what you have seen since that time is markets going up and down in at times in 10% increments per day. There was a day not too long ago where we had 16 plus or minus one moves during one trading session. And this is typical when markets get extremely volatile and investors get scared. That is something that our investment managers are able to take advantage of. Some of them are investing into this right now. And I would say by investment policy statement, we're not required to allocate away from fixed income and back to equities because we are underweight equities right now. But it's something that I want to encourage us to think about as we go through the early part parts of the second quarter. Now, if unemployment gets as bad as it could be, and you see estimates out there from 20% to 30% unemployment, which is not something I can recall ever seeing since the Great Depression. Hopefully, that will be resolved relatively quickly. But those are significant levels that we've seen. And although most of those are, it's I would say the nature of the unemployment this time is different from all others. We're all trying to do what we can to help support the workers in the country. This will be a quick slowdown. The economy is effectively going to a shock down rather than a um, rather than a more normal event leading to a recession. So quickly on page 3, you'll see of the monthly report. You can see at the end of that month, the market value was $284 million. As of last night, it was $251 million. So we had a drop from the end of February. March will go down as a historic month in the markets. When we look at the market value changes during the month of February, on page 3, you can see that the decline for that month was $12 million. And you look down and you see the equities were down a total of $17 million, and our fixed income composite was actually positive, $4.9 million. Now, even those assets have sold off during this bear market as it deepened through during March, and I'll have those figures for you relatively soon. The Hoisington fixed income portfolio did perform as we had hoped during the month of February. But as you recall, in the deepest and worst day of the equity market decline, we saw the 30-year Treasury get to a yield of 0.7%. That's the yield to maturity on a 30-year U.S. Treasury bond, which is a historic low. Now, it has gone back up since that time to about 1.3 I saw earlier today. But even the 30-year Treasury sold off a bit during since this report was published. However, this fixed income did stabilize the portfolio. And one thing that I'm pleased to report to you is just about 2 weeks ago, if you had gone to your bond managers, Siegel Bryant and Barrow Hanley, and said to them, we need to raise capital to pay benefits out, it would have been difficult to do that. The markets, the fixed income markets were so seized up, and so they were in a really, really poor shape. So one of the things that we did see the federal government do was they are effectively buying corporate bonds. The Federal Reserve is buying corporate bonds in the market to get that part of the market going again. And it was reported that yesterday we saw our first high yield bond issue. It was Yum Brands, which is, I think it's Taco Bell, Kentucky Fried Chicken, all of that. Actually had a sizable new issue in the high yield market. It was oversubscribed. And it functions. It looks like we're back to functioning normal. So looking at that list, we do have significant assets that are liquid. We've been keeping those liquid, and we've been drawing down assets. If you look during this period of time, we took $2 million during February from Barrow Hanley equity, as that was slightly overweight. They're not in that shape right now. And we also took $1 million from the equity portfolio. So looking forward, a couple of things just from a nuts and bolts functioning standpoint. However, the real estate conversation goes, we have an unfunded 5% allocation to real estate, which I think is a good thing to be going into. On the equity portfolio, it has proven prudent in the past, even when we are in uncertain times like we are now, to move gradually, perhaps 2 or 3 steps, to rebalance to equity targets. The equity market moves in advance of the economy. All equity markets started selling off when the recession hit hardest, and when the recovery happens, that has historically also occurred moving forward. And I know that's uncertain. I know that's By no means is this a guarantee that this will succeed, but if we look to the past, being diligent and being unemotional and being guided by our long-term investment policies is the proper way to move through a crisis like this. Any questions before I move further?
Doug, I don't have any questions, but I just have a comment. I really think we should follow through with that because we've been discussing a greater allocation to equities, and now so we find out if we really truly have the stomach for it or not. As you say, they will recover before the general economy recovers. It's always forward looking, as you well know. I wouldn't want to do this all in one step. I would be zealously opposed to that. But I really think we ought to start moving a little bit, because I think we probably are in oversold conditions here, but we want to be careful to make sure to see that employment, that this increase in unemployment is not sustained over a long period of time. We want to make sure of that. But I'm with you. I really do think we should start to do it if we're serious about making that transition. Because obviously, everybody talks about buying low, selling high. Sounds easy. It's never really easy because, in fact, when people are selling, they're selling for a reason, and it's usually a pretty darn good reason. But I'm with you. I think we should do it if we're serious about it as a board. And again, we discussed it. We were all on board with it when the markets were all to the upside. But we talked about waiting for some sort of pullback. I think we certainly got it.
Yeah, we certainly did get a pullback. So what the investment policy says is that, and I don't want to be very careful about following investment policy at times like these. It says that we check it on a quarterly basis. Well, that's as of close today. So our quarterly basis that we review investment policy versus target is as of the close of business today. So what I plan on doing is overnight getting the market values as of the close of business today and start formulating a plan on how to reallocate to our targets. And I think that, the performance is on the next couple of pages. It's been bad for the month of February, is down 3%. We're probably down about 11% from there through the end of business yesterday, but those are preliminary figures. But I think if I could ask you to turn to page 6, where we are, this is current market values. And again, to integrate in the real estate allocation here at 5%. But what we're talking about is taking money from fixed income, which if you think about long-term investing, rates are very low right now. And as a system that needs to generate a 7.5% rate of return, we're not going to get it from fixed income for the next few years until rates go higher. Rates are higher somewhat now than they were, but really to achieve our investment goal, I don't want to say this is an ideal way to do it, but I do think I agree with you, Dennis, that Mr. Treasurer, that the market is oversold. And I think that the reason that it sold off so quickly was fear. And I also think that there were some leveraged players in the market that were also forced to sell. And that's what happened in 2008 and 2009 that really led to the beginning of that market crash. And I'm not going to mince words. We're in a crash. We're in part of a crash. It's not as bad as it was 2 weeks ago, which was very difficult times. But there's light at the end of the tunnel. I'm hoping it's not an oncoming train, because that's always could be. But I think the health issue and the economic issues are front and center and will be for some time. So when we look at this list on page 6, what I will do is I will go with the new figures here, and I will put a proposed reallocation. And what I generally think works best is to do a 2 or 3 step process. Do it based on this month end, and then based on next month end. And then if we need to, go a third and do it on the month after that to get us to our long-term targets. And that's including the real estate allocation. Now, I do have some displays here. Page 7 and 8 are our market history here. So this compares on page 7. This looks at the 2008 financial crisis, the 2000 tech wreck. These are the two most recent bear markets that we've lived through. And then the coronavirus. And notice just how quickly the coronavirus has gone down. And this is through the 23rd of last month. Does not show the recovery that we've seen since that time. But if you look how steep the drop for the coronavirus is, you can tell that this was an economic event that shut down the economy very quickly, led to a panic. Look at 2008 financial crisis. It was deeper, much deeper than where we are today, and it lasted longer. And the 2000 tech wreck was even longer than that. So this is trading days on the horizontal axis, percent decline on the vertical. And if you look, forward-looking annualized returns after the index bottoms, we're not picking a bottom here. If you look across the top there, 1 year after the bottom of the tech wreck, the S&P was up 36% off of the bottom. 1 year after the bottom of the financial crisis, the equity market was up 72%. And if you look across here for the 3, the 5, the 7, and the 10, the returns are significantly higher off of the bottom. So again, we're not trying to pick the day, we're trying to allocate into it. Did I just go?
You're back.
Did I lose everybody there?
Yes.
Okay, there we are. And then the next page, page 8 of the packet today, is bear market drawdown, recovery, and performance. And if you look here, the duration of these drawdowns, these are past only. This is not including where we are today. But if you look at this going all the way back to 1929, you can see the depth of the loss. We were down pretty significantly, but the Great Depression was down 83%, down at the worst 30%. And the duration to recovery, if you do not rebalance versus the duration in months to recovery, if you rebalance 50% of the loss. So what this shows you in historical terms, and again, these are not meant to be projections of where we are now. It's just lessons that history has taught us, is that how quickly recovery is helped if you do rebalance into equities when they've sold off. That's the biggest thing that we want to do, is we want to make up the difference prudently, as quickly as possible. And that's what this shows you, that most of the time, a year later, things look much better off of the bottom. Are we at the bottom? No clue. I wish I had that answer. I don't, especially given the impact of unemployment coming on us in the next months. But historically speaking, rebalancing into depressed markets has been the best way to shorten the amount of time to ultimate recovery where we started these downturns. So happy to answer any questions about those.
Doug, when we talk about rebalancing, we have the S&P 500. We've got our small mid cap out of Dallas. Can't think of his name. I can see his face.
Yes.
I'm sorry, McClure.
Hanley? Yeah, Jim McClure.
Yeah, and of course we have the international, which I'm not really that interested in going there. But I think you're talking about the S&P. Are you talking about the S&P 500, or are you thinking about moving some to the small caps too? I mean, they tend to lead, but
Yes,
they're more volatile too.
Yeah, and again, I don't want to. They are more volatile. Studies show, and I'm happy to share it with you, that traditionally in environments like this, when you're looking for equity markets to move, the cheapest part of the portfolio is the small cap, mid cap portfolio. So I'm not saying put all of it in there, but I am saying that let's be smart about this. I like the cheap market exposure from the index fund. And I think that's definitely going to play a part of it. And I think that also I would encourage thinking about reallocating to international equity. And I understand. Yeah, I completely understand that. The U.S. is going to lead the way out of this crisis, but I think that some of those other countries there's some opportunities there as well. So those are the three main areas that I'm thinking about allocating to. And also, when we're thinking about the real estate allocation, I know it's taken a lot longer than we wanted it to get to this point, but I think this is a timely entry point for our real estate investments also. The people who can invest today, especially in this 4+ type marketplace, you think that equity investors are the only ones who sell when the markets go down. Real estate folks, sometimes they get over leveraged and that creates opportunities as well. So I think that that's a direction that I would like to go also.
Yeah, I'm with you.
So, yes.
One more question related to some of this stuff. What are your thoughts on the impact we've got in our portfolio related to crude prices being so low?
Well, it's really hitting one area really hard. There's the nice thing about the midstream portfolio, the MLP portfolio, is that we have not added to that. I do not think we should add to that at this time. The portfolio is significant allocation to cash in it right now, which I don't think that we should reinvest immediately. But the yields are there, and living where we live right now, I mean, that's the part I haven't spoken about, is that everywhere else in the country, it's gasoline prices are cheap. That's great. That's helpful, right? That's a tax. That's the effect of a tax cut on the rest of the country. But around here, we know it's cuts both ways. So as far as the energy exposure in the S&P 500 index fund, very low, historic lows. As far as our active managers investing in there, they are very low as well. Their allocations are low. I asked Jim McClure about it. How do you avoid the temptation of investing in something that cheap right now? I said it's really easy. He's not having to do that right now. He's not tempted to go into it just because it's cheap, because there are global factors that he can't quantify that are driving the price of oil low. I did see prices of oil is up slightly today, but yeah, that's one part of the portfolio that I recommend allocating back.
Okay.
Thank you.
Any other questions? Thank you, Doug.
Thank you.
Yeah, thank you.
Okay, we need a motion to accept and file.
So moved.
Second.
Baker? Hurd?
Yes.
Lord?
Yes.
Pierce?
Yes.
Kindler?
Yes.
Willis?
Yes.
Kaiser?
Yes.
Little?
Yes. Okay, we're gonna go back to, action A for treasurer's report. John, please.
Where do I stand? A little back. Middle back? Just stand back. Hi, everybody. I'm gonna give my report off screen. So the treasurer's report, as you can imagine, is a little dated at this point. February, we were looking great, and we're at 285 million fiscal year to date. And see, the domestic equities were up 3.4% up until February, so we were doing really, really well. Corporate bonds were down a little bit. Domestic equities were down slightly at the end of February, and then international equities were down 2.5%. So, of course, all that flew out the window when COVID came around. So, the changes in assets weren't very dramatic. We had a net investment income of $2 million starting out for 2020, and that's been, of course, wiped away. So, are there any questions about where we were before all this happened?
Okay, thank you, John.
Thank you. Sorry about my delay.
And we need a motion to accept and file the treasurer's report.
So moved.
Second.
I'm sorry, John, did you have a question?
He moved.
You said it.
Whatever.
Baker? Hurd?
Yes.
Lord,
Yes.
Peters,
Yes.
Similar,
Yes.
Willis,
Yes.
Kaiser. Yes. Little.
Yes. Next, discussion and possible action on committee reports. It looks like we don't have any reports for the benefits committee or the investment committee. Next is chairman's report. I have nothing. As discussion and action on refunds to be paid by April 7th, I'll take those 1 through 7.
Move approval.
Second.
Baker. Hurt,
Yes.
Lord,
Yes.
Peters,
Yes.
Similar,
Yes.
Willis,
Yes.
Kaiser. Yes. Little.
Yes. Next, payment of the following invoices. ANCO, 20,000, TC Administrative Services, $15.50. Tulsa County Clerk, $6,857.55.
Motion approved.
Baker. Hurt,
Yes.
Lord.
Yes.
Lord,
Melissa?
Yes.
Peters.
Yes.
Similar,
Yes.
Willis,
Yes.
Kaiser. Yes. Little.
Yes. Next, discussion and possible action on a waiver of 15 days prior to the effective date for the retirement applications of Justin Bradford, Rebecca Goldman, employees that were laid off on March 18th, 2020 with no notice.
Move approval.
Second.
Baker. Hurt,
Yes.
Lord,
Yes.
Peters,
Yes.
Similar,
Yes.
Willis,
Yes.
Kaiser. Yes. Little.
Yes. Next, approval of retirement pay applications effective April 1st, 2020. Justin Bradford, Jeffrey DiCello, Diane Floyd, Rebecca Goldman, Ardina McCormick, John Yancey.
Move approval. Second.
Baker. Hurt,
Yes.
Lord,
Yes.
Peters.
Yes.
Similar,
Yes.
Willis,
Yes.
Kaiser. Yes. Little.
Yes. Next is discussion and possible action, review and execute real estate contract with Prizza 2 LP.
Your turn.
Okay. We have. On the camera, I'm Jim Ray, Assistant District Attorney, represent Board of County Commissioners, and also been consulting with the Employees Retirement System of Tulsa County's retained lawyer, in this case, Phillips Murrah, Beverly Brashofsky, who primarily took the lead on reviewing and making revisions to the proposed documents for the contract. In the form of the contract, there's a subscription agreement to subscribe in the partnership unit, certificate of legal existence, as well as certificate of authority and the authorized signatory. Also W-9, each for the employees retirement system to review and consider for approval today. We have a detailed list of signing instructions. If you have those before you and you want to consider those, we can go through the specific page numbers.
We have that.
They were included in your packet, not the instructions to sign, but the contracts were included in your packet.
I guess I didn't get that.
It's on the electronic back here on my iPad. Jim, is there anything, I know this has been a more complicated matter than what our typical contract might be. Are there any highlights or anything you think we should discuss or talk about, or is your recommendation for us to approve and move this contract forward?
My recommendation is to approve and the documents prepared in such a way that the warranties and representation paid on behalf of the retirement system are not being made by the county commissioners. The retirement system itself is an investor in this transaction. That's why the entire employees retirement system is engaged with the documents themselves. I recommend approving them when we have those, we can bring them in after the meeting for your normal course of action that you take. I'll also address the PEPF transaction for you all to review and discuss while I'm here, so that you know your attorney at Phillips Murrah has represented. There are some. She's been passing multiple revisions back and forth with the PEPF fund. They have not accepted all of our proposed revisions. And one of the main issues is jurisdiction. PEPF has not yet agreed to approve jurisdiction for any litigation or interpretation of the agreement in Oklahoma. They have also pushed back on some tax exemptions, which could affect distributions made during the life of the fund, whether those are withheld from distributions to the retirement system. So there are, I think when we last talked about it, there's also a deemed consent provision of the limited partnership agreement. So limited partner, or the general partner would send out proposed amendments to, for instance, the subscription agreement or the limited partnership agreement, which if the retirement system did not respond to within a set amount of time, 10 days in most instances, we would be deemed to have consented. Also refused this part, not agreed to provide a list of other limited partners in the partnership, which might be fair disclosure to consider for a public body to consider who their other partners are. So a number of things like that. And those and additionally, even if the PEPF contracts were approved today, we would not be able to get into the subscription queue until the next quarter. And even in the queue, depends on your placement in the queue, whether or not your capital is called to fulfill that quarter's investments. So we still have, potentially the PEPF investment might be funded and obligated, but not filled for another 90 days.
So, I'll be willing to move approval on the PRISA contract. It sounds like we need to hold the other one.
They aren't even prepared.
Yeah. So move approval for the PRISA 2 LP contract.
Doug, did you want to add anything regarding the PEPF?
Well, we'll wait on, we do this and then we'll go to that agenda item. Is that all right?
Baker? Hurt?
Yes.
Lord?
Yes.
Peters?
Yes.
Similar?
Abstain.
Willis?
Yes.
Kaiser? Yes. Little?
Yes. Next, discussion of possible action, review and execute the real estate contract with the PEPF fund.
Sorry, I jumped ahead earlier on the agenda item. Those documents are not in a completed stage. The revisions have gone back and forth with the investment fund and retirement board's attorney at Phillips Murrah, and they've not reached an agreement on the final form of those documents. There are potential issues with those documents in the form of ultimately the agreement that the board may want to consider with regards to that investment. Again, the timeline for that investment, even if those were approved today, we would not be in the investment queue until the start of next quarter. So there is additional time to consider those between now and then.
We need a motion to put this.
We can defer either whatever, Tracy, you think, Doug?
Doug, did you want to say anything regarding the PEPF contract?
Sure. I think that I'm just trying to think about our options here. So our allocation, we're going to split it 2.5 to precinct 2, which we just approved, and then the other 2.5% to PEPF. I don't like how they're negotiating. It remains to be seen that we can come to terms. I hope we can come to terms with them. But one of the interesting or positive features of the type of funds that these are is that we will be able to, if we can't come to terms with PEPF, we have the ability to allocate their portion to 360. We could do that. I kind of like the idea of being diversified, but if the way that the documents are written are unacceptable from a legal perspective, I'm not going to disagree with that because that's not my purview. I think either of these funds will do a nice job. Both of them together would be more diversification. But as far as being able to have a plan B in case we don't are not able to come to terms, yeah, that is out there. That's really the extent of my comments on this. It's been a lot harder than I expected it would be, and I do apologize for that. But sometimes first time into these assets is a bigger lift than you would expect.
I move to defer for a moment.
Second.
Baker. Hurd,
Yes.
Ford,
Yes.
Peters. Peters,
Yes.
Kemp,
Yes.
Willis,
Yes.
Kaiser. Yes. Little.
Yes. Thank you. Any new business?
Not that I'm aware of.
Okay, we have a motion to adjourn.
So moved.
All those in favor?
Aye.
Thank you, everyone.
Thank you.
Thank you.
Bye.
Bye.
Heather, did you want to get selfies with everybody else before?